If you only ever buy one ETF for the rest of your life, this is probably the one. Not because it will make you the most money. It won't. Not because it's the cheapest. It isn't. But because it's the one fund you could buy today, hold for 40 years, and never have to think about again. For most European investors, that's what the world best actually means here. Let me show you what it is, why it earns that title, and just as important, who it is not for. In my last video, we put the two giants head to head, the S&P 500 against the MSCI World. If you are trying to choose between regions, start there. But a lot of you wrote back with a simpler question. Ivan, I don't want to choose. Isn't there just one fund that owns everything? There is, and that's today's video. Before I say a single fund name, let me be clear about that word, best. I do not mean best returns. A US index like S&P 500 has beaten the global index over the last 10 years, and I'll show you that honestly in a minute. I don't mean cheapest, and I don't mean the best portfolio you could possibly build. That's a later video. I mean the best single fund to own if you want one decision made once that still makes sense in 40 years. Best for simplicity. Best for spreading risk. Best for something you can actually stick with. The fund is FTSE All-World Tracker. The best known is Vanguard's. The accumulating version, the one that reinvests your dividends for you, usually shows up as VWCE. The distributing version, which pays them out, shows up as VWRL. One heads up, those tickers change depending on which exchange you buy on. The thing that never changes is the fund's ISIN, its unique ID, so when you go to buy, search by that, not the ticker. I'll put both on screen now so you don't have to write anything down. It is a UCITS fund, domiciled in Ireland. Exactly the structure we said European investors should use. The accumulating version alone holds over 40 billion euros, which makes it one of the biggest of its kind and keeps it cheap and easy to trade. Inside that one fund, you own over 3,700 companies across nearly 50 countries, developed and emerging markets, the whole investable planet, from Apple and Nvidia all the way down to companies in India, Taiwan, and Brazil, for example. Now, a word on cost. The one number that's genuinely in your control. This fund charges just 0.19% a year. On 10,000 euros, that's about 19 euros a year. Trivial over a single year. But that's exactly where most people quietly lose money. A typical expensive, actively managed fund might charge you around 1.5%. Run that gap across 30 years of compounding and the cheap fund can leave you tens of thousands of euros better off. On the very same money for doing nothing different. Low cost isn't a detail here. It's a real part of why this boring fund beats the clever, expensive ones. And I'll be straight with you. I spent years inside the industry. Those expensive, actively managed funds I'm warning you of, that 1.5% isn't an accident. It's the product. It's where the firm makes its money, not where you make yours. Seeing that from the inside is a big part of why I trust the boring, cheap fund. So, why does one boring fund earn the word best? 4 reasons, and they build on each other. 1. Simplicity. One fund, one transfer a month. Nothing to rebalance, nothing to compare. No second fund to add later. You are done. And this matters more than it sounds. The investment you actually stick with beats the clever one you abandon. And nothing is easier to stick with than a single line in your account. 2. Diversification. When you own the whole world, you stop betting on one country being right. If the US keeps leading, you own it. If Europe or Asia takes the next decade, you own that too. You don't have to predict the winner. You hold all of them. and the winners carry the fund. That is the closest thing investing has to a free lunch, and a single fund hands it to you. 3. It looks after itself, and this is the one people miss. The index rebalances for you. As companies grow, they take a bigger place. As they fade, they shrink and drop out. Whole countries rise and fall in the mix automatically. This index looked very different 20 years ago, and holders didn't have to lift a finger. You will most likely never need to switch out of it. Buy it once, and it keeps itself current for life. 4. And quietly, the most valuable. Because there is nothing to tinker with, there is nothing to get wrong. Remember the mistake that cost me the most: waiting and second guessing. A fund this boring protects you from yourself. No fund of the month, no chasing last year's winner, no panic switching. Here, boring is the feature. So, who is this actually best for? The beginner who wants to start today and not need a finance degree first. The busy person who wants to genuinely set it and forget it. Anyone who wants one decision instead of a new hobby. And anyone with a long horizon, 10 years and up, who is happy to own the whole world and let time do the heavy lifting. If that is you, you can stop the search right there. This is the one. And who is it not for? If your goal is the maximal historical return and you believe the US will keep leading, a focused S&P 500 fund has done better and might suit you more. If you enjoy building and tuning a portfolio, tilting to value, overweighting emerging markets, adding bonds, then this single fund is your starting point, not your endgame. And if you need income to spend now rather than growth, you'd look at the distributing version instead. Best if you only want one is not the same as best for everyone. And anyone who tells you one fund is perfect for every person is selling something. So what has owning the whole world actually done? Take this very fund. Since it launched in 2019, straight through a pandemic crash and the 2022 downturn, it has more than doubled. To make that real, 10,000 euros put in at the start would be worth over 20,000 euros today. But 7 years is short, and it was not a smooth ride. At its worst, it fell about a third before recovering. Step back further, and you see the real engine. Over the long run, the global market has compounded at roughly 7 to 8% a year. Never in a straight line, but firmly up across recessions, crashes, and recoveries. That is the whole thing. No tip, no timing. Just owning the world's businesses and letting them compound. Every figure is on screen and linked below. Check it yourself. Now, the uncomfortable part. If you go and check the numbers, and you should, you'll see the FTSE All-World index this fund tracks has trailed the S&P 500 over the past decade by a wide margin. US tech carried that period. So why would I still call it the best fund choice? Because best here was never about winning the last 10 years. It's about not needing to be right about the next 10. Owning the whole world is the bet you make when you are honest that you don't know which region wins from here. And most of us, myself included, don't. One practical note before the wrap. Accumulating, like VWCE, reinvests the dividends for you and is the simplest choice for most people building wealth. Distributing, like VWRL, pays them into your account. Which one is actually better for you comes down to your country's tax rules. And I walked through exactly how to check that in my separate video on accumulating versus distributing ETFs, linked below. And practically, how do you actually buy it? Open an account with any broker that offers European ETFs and search for the fund by the ISIN I showed you earlier, not the ticker. So you always land on exactly the right one. Then automate it. A standing order for the same amount every month, both the day after payday, for example, before you can talk yourself out of it. That's the whole machine. One fund, one automatic transfer, and you've quietly out-invested most people who spend their evenings picking stocks. So, if everything else fades, keep this. If you want to invest and never think about funds again, you buy one all-world ETF every month and you hold it. That's the whole strategy. The rest is detail. In the next video, I want to answer the question sitting underneath all of this. Is this actually safe? Because owning one fund of over 3,700 companies isn't a bet on a price chart. It's owning real businesses, their workers, their products, their profits. The opposite of speculation. I'll show you exactly why that makes index investing the closest thing there is to a sure thing over a lifetime. Subscribe so you can catch it. And to be clear, I am not a financial advisor and everything here is a general education, not personal advice. And if this made the choice simpler, a quick like helps it reach the next person starting at 100 funds with no idea where to start. I am Ivan, this is the Banker's Notes.